In this episode, I'm going to share 5 things you need to look into to increase your chances of being approved for an auto loan, and that's going to save you the most time at the car dealership.
You would always want to be on the side of having good credit.
You think it pays to have good credit? We have so many clients with Sturgis Credit Repair who call in or email or message stating that they're trying to improve their credit scores to purchase a vehicle. Now, this episode isn't to discuss if financing a vehicle is a smart decision or a dumb decision. This is just pointing out 5 things you need to study and make sure that it's in check before you go to a car dealership. If you don't agree with financing a vehicle, well, this episode may not be for you. But for those who are trying to improve their credit to purchase a vehicle, or you may have great credit and you may be curious on what are some things you need to know before you go into the car dealership, this episode is for you. So listen up. Number 1, LTV, which stands for loan to value. A bank or credit union or lender, whatever you want to call it, they will not give you more money than what the vehicle is worth. Loaning money is a business. A bank loans you money, therefore a bank is a business. Therefore, if a vehicle is worth $30,000 and you roll 20 grand in negative equity from one of your trade-ins, that bank is not going to put their money at risk, because the chances of that vehicle being paid off before it breaks down or you lose a job or whatever the case is, the chances of that is very slim, and it's putting you at a high risk category. So a bank is only going to approve you if you have perfect credit. They're just going to approve you based on the vehicle's value and whatever taxes and warranties and things like that is added to the vehicle. I think in most cases, most banks will go up to 120% of the vehicle's value. So 2 things is going to go on with this topic. Number 1, you have people that go to the car dealership and they want to sit there for hours and hours and argue with the salesperson stating that, oh, this vehicle, you're selling this vehicle for more than it's worth. No, they can't, because the bank will not finance it. 9 times out of 10, dealerships know what they're doing when they're pricing a vehicle. So if they have a vehicle that's worth $30,000, they're probably going to list it on their website or list the selling price as $29,000 or $28,500 or whatever the case is. Usually they're right at book value or right under book value. Well, Chris, why is the dealership going to list the vehicle for less than what it's worth? Shouldn't they be marking it up more so they make more money? Not necessarily. A dealership make money by selling cars. If they can't sell any vehicle, the car salesman doesn't get paid, the managers don't get paid, the financing manager does not get paid. So they know taxes are going to be added to this value. They understand a lot of people will not have a down payment. They understand many people will have a trade-in that is going to carry negative equity onto the new vehicle loan. Therefore, they purposely price their vehicles right at or right below book value. So therefore, whenever they go and apply for financing, they're within that 120% loan to value. And that's if you have great credit. Look, if you have bad credit, they're not going to finance 120% of the vehicle. They're not going to finance the taxes, extended warranties, gap insurance, the $1,000 or $2,000 that you're upside down on your trade-in. They're not going to finance that. They may want you to put money down, but that's later in this episode. We're going to talk about that. So number 1, you need to focus on loan to value. If you know you're carrying over tens of thousands of dollars of negative equity, that's going to be an issue, and you need to pay that down before you go to a car dealership. Number 2, more relating to your personal finances, DTI, which stands for debt to income ratio. Most banks, lenders, credit unions, whoever you want to use, most of those guys will only finance you up to 40% of your gross monthly income. Meaning, just to keep it easy, if you make $10,000 per month, they will only finance you up to $4,000 per month. 4,000 into 10,000 is 40%, right? So let's just say you make 10 grand a month and you don't have any auto loans, right? You don't have any auto loans, you don't have credit cards, but your housing payment is $4,000 a month. In your head, you're like, oh, I have an extra $6,000 of gross income that I make. Well, this shouldn't be an issue because I, have $4,000 in housing expenses and I have $6,000 left. This is going to look good on paper. No, you're considered a high risk, right? It doesn't matter if you don't have an auto loan. It doesn't matter if you don't have any other credit card debt. If you make 10 grand and 4 grand is used up, well, your 40% of debt to income is all washed away right now. If somebody makes $5,000 a month, half of what the other person made, and the only bill in their name is $800 car payment and some credit cards and things like that, well, they have some room left for an auto loan. They can get a $500 a month or a $600 auto loan or car payment or whatever you want to call it because they have room left. Their DTI may only be at 25% or 30% and they have an extra 10% to go. So keep that in mind. It doesn't matter if it's a vehicle, if it's a home or whatever that you're financing, personal loan, banks will not go over 40%. If they do, it's going to be very, very, very high risk and a very short-term loan. So most people, when they go to a car dealership, they're expecting their car payment to be based on a 6-7 year loan these days. That's going to keep the payment lower. Now, if you go in there, you're already at 38% DTI, and this car payment is going to push you to 42, 43%. Well, banks are going to say, hey, we're not going to finance you for 72 months. We're going to keep this down at 60 months, or we're going to keep this down at 48 months, right? They may only finance it for 4 to 5 years because you're at a high risk. And guess what? That car payment is higher and that interest is higher, which means that's more money that you're paying realistically per month. So keep that in mind. DTI is an important factor. And I must say that is one of the hidden factors when it comes to applying for financing in general. Number 3, common sense, which is credit scores, right? This is actually the first thing that pops up in someone's head when they finance anything. They wonder what their credit score is. Yes, if you're already wondering that, it's common sense, right? If your credit score is in the 600s, you're usually in a good spot. Honestly, you're going to possibly have to put some money down because you're usually in that tight spot of being considered a high risk or a low risk. And the reason why I started this category out with the 600 credit score people is because majority of my clients that reach out to me asking if they can get approved for an auto loan, their scores are usually between 620 and 650. Now, for those of you who have 700 plus credit scores, this category here isn't for you, right? You probably shouldn't have any issues. Now, for my people who are listening or watching that have 600 credit scores, well, you may potentially run into issues. If you have too much negative equity carrying over, you're going to get denied. If you have too much debt already and your DTI is already at 36, 37%, well, that's considered high risk. Your scores are considered high risk. The chances of you being approved is very slim. So if you're 600s, you're going to have issues. If you're in the 700s, no issues. If you're in the 500s or below, you know you're going to have some problems. And 9 times out of 10, you're going to need a lot of money down. We're going to talk about that next. Number 4, as I just mentioned, down payment. Now, if you have issues with your credit and your finances, one way around it, and this is after speaking with so many people in the car industry, I've been told, I don't know if this is 1000% true. I'm not, in connection with anyone at a auto lender, but majority of the people that's in car sales and finance managers that I have personally spoken to, they have told me if you have credit issues, put 15% down. So if you have a $100,000 vehicle, put 15 grand down, and your ways of being looked at as a high risk lowers, right? Same thing. If you have a $30,000 vehicle, you put 5, 6, 8 grand down, you're going to lower your chances of being viewed as a high risk. Why is that? Why do banks want 15%, 20% down? Why do they look at you differently? It's because it's a money game. It's a business. At the end of the day, when you finance a vehicle, that vehicle is collateral, right? If you stop paying, the bank is going to take that vehicle and sell it at auction. They're going to get their money back. So when you're giving the bank money up front for collateral, at that point, you're not viewed as a high risk. This is more like a business opportunity for the bank, right? So let's say you have a $100,000 vehicle and it's valued at, and you put $15,000, $20,000. Well, you're already at what, 80, 85% LTV. So the bank is looking at it as a business standpoint, right? They're like, okay, well, we're already 20% in on this deal. If this person doesn't even make the first payment, we're going to repo it and just sell it at auction. We've already got 20% in on it. So we just need to sell this for 80% of the vehicle's value. They're already ahead. It's a win-win. So do that mean you're automatically going to be approved if you put 20% down? You have a 350 credit score? You probably going to need a little bit more money down, but it does mean for people that are listening who have 600, 610, 620 credit scores, you put 15 to 20% down on a vehicle, your chances of being approved goes from this to this, right? It goes from low to high. So down payment is something else to consider. Money talks is something else to consider if your scores are out of the 700s and they're 620, 630, 580, maybe 590. Money talks. And last but not least, number 5. This is more, I guess, relating to credit scores, but we're going to go over your credit reports, because a lot of people, when they go to apply for any sort of financing, I see this a lot when it comes to mortgage people or mortgage applications, people who are applying for their first home or refinancing their home or buying a second home, third home. A lot of this happens in these situations. People look at their credit scores and they're like, oh, I have a 715, I have a 720, or I have a 680. I should be fine. My credit isn't the best, but it's good enough to apply for anything, because the minimum credit score on a lot of things these days are like 680, 620, 650. I should be more than, able to get approved for whatever I want to use my credit for. Now, is that true? Probably to a sense, but is it 100% true? No. What's on your credit reports matters more than your credit scores. Now, what I mean by that, risk, you're going to be based on certain risk categories. So let's just say you have a 700 credit score, but you have 2 auto repossessions from 6 years ago. They're both about to fall off of your credit, and it's taking you 6 years to finally build your credit back up. Those 2 items are old, and they only have 8 months left for reporting before they naturally age off. So therefore your scores continue to grow. Now, when banks look at your credit, they're going to say, oh, 700 credit score. Okay, pre-approved. We're going to go to the next process. Let's look at DTI. Let's look at his credit reports. Let's look at his history. Let's see all of these things he didn't pay. When they get to the point where they see auto repossessions on your report, they're going to go, hold up. They're going to pump the brakes, and they're going to value your risk based on things that are reporting to your credit reports. If you have a history of not paying back auto accounts, regardless if you have a 700 credit score or upper 600 credit score, okay? Anything below 720, I would say, is still in that category of people that are between 650, 680, whatever the case is. Just because you have a 7 in front of your score, a low 700 is still not excellent credit. Banks usually don't automatically rank you as low risk until you're about 750, 760 plus. So anything below 750, you, believe it or not, can still have some issues. So if you have anything that's on your credit reports, bankruptcies, auto repossessions, multiple charge-offs in the past, regardless if your credit score is above that minimum 620 or 640 that most banks and lenders want, you still can run into some high-risk issues if you have bad things on your credit reports. Those are 5 things you need to look into when it comes to applying for a vehicle. If you do need help with your credit, please visit SturgisCreditRepair.com, click sign up, start your free trial today. If you have questions on this episode, feel free to drop those down below in the comment section. And as always, subscribe to the channel. Stay tuned for more. Thanks for tuning in to this episode. If you wish to be a guest on our podcast, visit SturgisCreditRepair.com and click the podcast page to schedule an episode. If you need help with your credit, you can also sign up at SturgisCreditRepair.com and start your free trial today.
Sturgis Credit Repair. repair. If you want a new house, call us.